How's it going, everyone? This video is going to be over Cameron's model. We'll first start the video with a PDF walkthrough going over the criteria, and then we'll hop into the chart and go over some examples. So this model is made up of three components: a draw on liquidity, a stop rate, and then an entry. The first thing is a draw on liquidity. I'm looking for an old high or old low on a hour or 15-minute chart. So if there is no draw on the hour chart, I can drop down to the 15-minute chart. But as you can see here in this example, we have this old high on the hourly chart here, and price is drawing up towards it. I can anticipate price reaching for this high, so this will be my draw on liquidity. The next thing is a stop rate in the opposite direction of our draw on liquidity. So in the previous slide, our draw was above us, so looking for bullish price action. So to find this setup, I'm looking for a swing low to be taken out. If it was bearish, I'd be looking for a swing high to be taken out. I am then looking for this stop rate in an up close candle. When this candle closes up close or back into the range, I am then dropping down to the 30-second chart. Down on the 30-second chart, I'm looking for a fair value gap entry. And so you can see here, this is the 5-minute stop rate. We close back in the range or close up, making a fair value gap. We return to the fair value gap. This is my entry. And on NQ, I'm looking for a stop loss of 12 handles or less, or 12 points or less. And then I'm targeting a fixed 1-to-1. But we'll also talk in the end of the video how I personally change this. So let's get into some examples. In this first example, we have NQ on the 15-minute chart. You can see we closed inside this 15-minute candle. So I'm anticipating price to reach back down into this internal range liquidity, going external to internal. With that idea in mind, I'm going to drop down to the 5-minute chart. Here on the 5-minute chart, I am looking for a stop rate in the opposite direction of our draw on liquidity. Since our draw on liquidity is down towards this 15-minute fair value gap, I'm looking for a swing high to be violated. And if you look right here, we have swept this high, and then I'm looking for a down close candle to form. So letting that down close candle form, you can see we form it here and close. From here, I'll drop down to the 30-second chart. So here we are in the 30-second chart, and you may notice we've already had a 30-second fair value gap that is starting to play out. However, according to ICT, we want to wait for that down close candle, but we will talk about this in the end of the video. But now I'm waiting for price to draw to this 15-minute fair value gap and waiting for a 30-second fair value gap in that direction. So let's see what happens. So right here, we have a small little fair value gap. So looking to enter there, I would put my stop here. I'd have a fixed 12-point stop. And then I would be looking for a 1-to-1, like so. Let's see how this works out. You can see if we miss this one, we have another fair value gap here and another opportunity to enter. But let's see how this works out. So this entry would have worked out. Now let's see what would have happened if we would have taken this entry here. And that one would have worked out as well. So you can see we went from a 15-minute draw into this internal range liquidity to a 5-minute sweep where we swept this high. Then after this 5-minute candle closed down here at 11:50, looking for 30-second fair value gaps to gain an entry. In this next example, we were working right off our previous example where we went external liquidity to internal liquidity, and now I'm looking for internal range liquidity to reach for external range liquidity. So here my bias is up. So with that idea in mind, I drop down to the 5-minute chart. Here on the 5-minute chart, I want to look for a 5-minute sweep, which we have here when we entered that 15-minute fair value gap. Now I'm waiting for an up close candle. Here we get an up close candle, so I will drop down to the 30-second chart and look for an entry. Now, once again on this 30-second chart, you can see that initial fair value gap that we would have missed waiting for the 5-minute close. However, let's wait for another fair value gap. So here we have a fair value gap. Let's look to enter with a 12-point stop and fixed 1R. and it looks like it just misses us. However, it puts in another fair value gap up here. So looking to enter here with our 12-point stop and 1-to-1, let's see what happens. And there we go, we hit our TP, and let's see how this continues and goes through our drawn liquidity or buy-side liquidity. In this next example, you can see we took this high on the 15-minute chart. We have a unfilled fair value gap resting below, which is also in a discount of the range. So I'm anticipating price to move lower towards this area. With that idea in mind, we'll drop down to the 5-minute chart. So here we are on the 5-minute chart, and I actually recorded this live, but my mic was muted. So here's the voiceover. So you can see that we took this buy side right here, and then we had a candle close down. So from here, I'll drop down to the 30-second chart and look for a fair value gap entry. So looking at the price action, you can see this fair value gap resting right here. So marking that out and then looking for a 12-point stop. And in this case, I used a 10-point stop since there is no point in moving it over that high. Looking for a fixed 1-to-1, I put my TP right here. And then let's see how this plays out. So you can see that price hit our TP, but let's hop back into the chart and go over this. So reviewing this example, we took this previous high and anticipating a move back into this fair value gap that is in discount. Dropping down to the 5-minute chart, you can see we took this previous swing high, creating a stop raid, and then had a down close candle. From here, we dropped down to the 30-second chart. In the 30-second chart after that down close candle, there was a fair value gap here, looking for an entry here. I stop on the high here at 10 points, since it doesn't make sense to add an extra 2 points over this high for me. Then looking for a fixed 1-to-1. But you can see that if we were to hold towards our draw on liquidity, or this initial consolidation here, we'd be looking at a trade of 4.22R. Now this leads me into the last part of the video where I talk about how this strategy can be adjusted to fit personal needs. I personally prefer a strategy with a higher risk to reward and taking profit at structural targets. So for example here, if I was going to be short, I'd want to be looking to take profit at a low or a fair value gap or somewhere where it makes sense for price to reverse. So if we go back and look at our previous examples, where would I be looking to take profit on them? So here we have the 3 examples we went over with our fixed 12-point stop, or on this one was a 10-point stop. Now where would I look to take profit where it makes sense for me? For me, it would make sense to take profit a little bit lower here at this low or on this previous 5-minute low, which would give me a slightly higher risk to reward. Now it's more notable here in this second example, as if we reach for this previous high, which is where I'd anticipate price reaching, it would give me a 1.83R versus a 1-to-1. And then in this last example, as we mentioned, I reach for this previous low, or at least into an OTE or discount of this range here, which would give me at minimum 2R. So what else could I do to adjust this strategy to fit my needs? Personally, I don't really like waiting for the 5-minute close. I would prefer to wait for displacement and an entry model on that lower time frame at that liquidity sweep. So what would that look like? So let's go through each example one more time and how I would trade it. So in this section of the video, I will go through each of the examples discussed earlier and how I would personally adjust them. So here we are keeping the same narrative of price reaching for this fair value gap below. Dropping down to the 5-minute chart, we get our sweep here. And then let's drop down to the 30-second chart. So here on the 30-second chart, if you understand the box setup, you see this aggressive out, aggressive down. You know that this previous highs, when they get retested, would be an ideal entry short here. But if I'm waiting for a little bit more confirmation, I'd want to see some displacement below this low. So let's see what happens. So here we get displacement below this low, and from here I could either look for this order block or see if a fair value gap forms. So here we get a fair value gap, and then from here I generally would look to target here. And on the lower time frames, sometimes these will get swept, so I'd want to have my target there, and then I'd be looking for this low. So let's see how this works out. And there we go. We run this initial low here into that fair value gap, giving 1.55R. In this second example, I would be looking for price to go from internal range liquidity to external range liquidity. Dropping down to the 5-minute chart, we have our sweep here, and not looking for that close back in, I immediately go down to the 30-second chart. Here I am waiting for an entry model and aggressive displacement out of this area. So this isn't enough displacement for me. We're just reacting off of that fair value gap. Here we get a nice close below. So if I'm looking for a model, I'd want to see this break this high. So we get displacement and close over. And if you've seen my last week's video on the unicorn model, we now have this breaker block with a fair value gap here. So I'd look to enter in this fair value gap, my stop on the low, and here I'd be looking to target this previous high or my draw on liquidity. Let's see how this works out. And there we go. We hit our TP. Let's go to the last and final example we went over. So in this last example, on a Monday with no news, I'm anticipating price to be range bound, sweep highs, come back into the range, sweep lows, come back into the range. So I'm looking for price to go from this side of the range down here. So dropping down to the 5-minute chart, we have this sweep here, and I'm not waiting for any other reaction besides the lower time frames, so I'll go immediately down to the 30-second chart. So here we are on the 30-second chart. If I'm looking for a box setup, I want to see a very aggressive move back into this range immediately and closing below this previous high. So let's see if that happens. And no real displacement back in there. So now I'm looking for another high to be put in. Okay, so we put in a new high. That is a sweep. Here we put in a short-term low. And then we displace down into this little volume imbalance. And what do we have right here? A small fair value gap. So I'd be looking to take an entry here, my stop on the high, and then targeting this low. So let's see what happens. And you can see there's that second fair value gap entry. And there we go, we hit our TP. So there's lots of different ways to find entries in these models. You know, if we wanted to, we could look at this fair value gap here, which was then closed below and retested before the move down. There's so many different ways. If I'm looking for something that is more mechanical, I'm definitely going to wait for that up close or down close 5-minute candle and then searching for the 30-second fair value gap. However, if I was going to trade this the way I trade, I'd be looking for this 5-minute sweep and immediately going down to the 30-second and then looking for my entry there. I hope you enjoyed this video. If you did, please consider liking and subscribing, and I'll see you guys next time. Have a good one.